Okay, next up, we have silver. Silver's creeping up. This will be resistance. We know this is your longer-term trend line at 39, just above 39. The trend line goes back to December of 2022. And again, if we tag that and can break that, the next leg up begins in terms of just holding up. It's honestly impressing me to the nth degree. Just the mere fact that it's risk on in the markets and gold continues to hold up is just so impressive.
Although silver hit resistance at $39 an ounce, it still has plenty of momentum to challenge its 2011 all-time highs. A breakout above that level could trigger the next rally, targeting $44, followed by possibly $48 to $50. Gold's strength is also notable. It's holding up impressively despite risk-on sentiment in broader markets. Although silver is poised to move higher, Cawley noted that he does not expect it to continue outperforming gold. Silver's brief spike above $39 an ounce pushed the gold-silver ratio to 85.88, its lowest point since December. The ratio has dropped nearly 20% from its April highs above 107. Gareth Soloway, chief market strategist at verifiedinvesting.com, boasting over 26 years of trading experience, explains stock index futures on the Nasdaq and indeed S&P 500 both hit new highs on Monday as Canada withdrew its digital services tax on technology companies to restart trade talks with the U.S. after Trump on Friday said he was ending all trade discussions with Canada in retaliation for the digital tax. Sentiment remains positive for U.S. stocks thanks to the sudden de-escalation in the Israel-Iran conflict. Following the ceasefire, investors have rushed back to the more volatile tech sector, which helped push the Nasdaq 100 to new highs last week before the S&P 500 joined in. Without a major bearish catalyst, the short-term forecast for the S&P 500 remains positive. While the dollar recently closed above a trend line, it hasn't confirmed that breakout, suggesting weak support. The 10-year yield is slightly down after a big bounce, hovering in a mid-range without clear direction. Fed official Waller advocated for a rate cut in July, citing a weaker-than-appearing labor market. However, since Waller is historically dovish, his comments didn't signal a policy shift. Overall, multiple indicators suggest caution, with limited upside unless key levels are broken convincingly. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
S&P futures to start the day. And what we could see is that overnight from yesterday, we saw a gentle float up and now a gentle fade. Now, net, if we look at where the markets closed yesterday to where they are currently, we're virtually flat. Take a look at that, guys. Again, yesterday's close to today, currently on the 10-minute chart of the ES S&P futures. All right, so again, overall, not much movement, upside in the overnight, but fading a little bit here towards the opening bell. Now, the biggest thing to kind of keep an eye on is yesterday, right? Yesterday, we opened basically flat, and there was a little bit of volatility early in the day, and then really we just kind of ground higher all day long. But remember, we were watching the S&P daily chart and some key levels. Let's go to that right now, flipping over to the daily chart. So these are the three trend lines. I call them the three horsemen, if you will, that I've been following in terms of major resistance. And then there's obviously the additional trend line I'll put in that I did yesterday and the day before that really kind of puts the exclamation point on things. But what we have here again is still all of this. And this is why I'm not so concerned about the market ripping higher. Although I have to admit, it could continue to grind. Grind, remember, is a slow grind up, small gains each and every day because of, again, new money slowly coming in. Ripping is obviously one of those big kind of godlike candles where it just spikes up dramatically to the upside or multiple days. That's somewhat unlikely because we have all of this resistance just in the overside of the S&P. In addition, folks, we have that secondary level here. This is the one that connects the low from April 7th. Notice no candle touches this line until we take it right to the low on June 23rd. We extend that out right to here, and this is where things get very, very interesting. If we zoom in, we can see it touches right there. We closed below, But remember, we did not confirm the breakdown. So you can close below, you can close above a level, and it can be a fake out as the confirmation signal teaches us. And that's exactly what this was so far. We had an initial downside the next day on Wednesday, a flush, and then the markets recovered. And then yesterday we floated up. But look at where the high of this candle went, right back to that trend line, but it stayed below. So that's something that I'm going to monitor now, is that this trend line now becomes instrumental, just like this one. Remember this trend line, how we were hammering it, hammering here. We broke below and we still actually went up a little bit. We went up and then we ran into that same line right here, right there again on July 3rd. We then started to have some sideways chop. We broke here. Now this becomes resistance. Now listen, it's an upsloping trend line. So like I said, could we continue to grind? Absolutely. But this trend line, if we extend it even further, it adds additional resistance to the S&P. So like I've been saying, folks, is sure enough, the markets could continue to slowly grind up, kind of climbing a wall of worry, if you will, with all the tariffs and trade wars and this and that. But ultimately, there is limited upside unless we really bust through this area on the S&P 500. Now, the other thing to keep an eye on here, folks, is that if we go to the Nasdaq chart, and this is, again, a very, very important chart, if we take a look here, you can see I've already drawn in the arrow. We have this bigger parallel that, again, I've talked to you guys about prior, that is really instrumental. And look at where the Nasdaq is at this point. So let me get rid of this trend line as well, so it keeps it as clean as possible for all of you out there. We take the COVID low, we connect it to the bear market low of 2022. Let's start from the scratch. How did I draw this trend line? I used my parallel tool right here. So you go into this right here, you go down to parallel channel on TradingView, and essentially you grab it there. Then you put the line from the major pivot low in COVID, which was the March 2020 low, to the bear market lows. And then all you do is you just stretch the parallel up till you get to the high from 2021, the bull market high. And all of a sudden, what do we notice here? We notice that when you came back in, you tagged that, but then when you went up in 2024, that was the exact high of the bull market in 2024 before our big Liberation Day sell-off. And look at where we're back to. And so again, you know, when you have the S&P 500 with all of these levels here that we just discussed, and then you flip it over to the Nasdaq and you say, wow, so wait a minute, the Nasdaq here, and bear with me as I bring that same chart up, the Nasdaq is into that major trend line as well. It tells me again that there should be, and I say should because remember, in trading, there is no guarantees. There's always risk. Nothing is 100%. But a high probability is that the markets, again, NASDAQ into resistance, S&P also into resistance, we're nearer a top than a bottom, essentially. In other words, there's more chance of a stall out, maybe a grind, but a stall out, and then eventually a roll over than not. And again, I would put it on about 70 to 75%, maybe even up to 80%, considering how extended we are on these charts, that we're close to that. So let's get back into some other charts here. I just wanted to go over that with you guys. The dollar today is grinding lower. Interestingly enough, the dollar closed above this trend line, but ask yourself, did it ever confirm? No, no, and still no. So that what that tells us, and by the way, this is just great education, and I love educating you guys because, again, it's things that I did not have as a new investor when I was young, and I lost a lot of money because of it. But education is number one. Here we have a downsloping trend line here. We broke above. If you don't confirm above a level, the level remains a weak level or a minor support. So it's still technically support. And you could see it yesterday. We came down, we pierced it, and we bounced up. But again, there's a difference between major and minor. So when I'm looking at trend lines, and this is something that I teach often, is I'm looking to decide, okay, is this a major support or resistance? Like, in other words, it's going to be a rock wall or a brick wall, or is it just kind of a fence, a weak fence, a post fence that you can knock down? And the answer is it depends on whether you've confirmed above or below the level, or if you haven't. When you don't confirm above a level, it tells us this line is still not really the greatest line in the sand or the greatest wall. Yes, it's a little bit of a wall, a little bit of a dip back it might hold, but as of now, this would be weak support here, meaning that it might bounce, but again, odds are probably at best 50-50 that this line holds if the dollar pulls back. Now, if the dollar continues and confirms, then this solidifies as a major support and the odds start to favor a move up to that 100 even number. Looking at the U.S. 10-year, the U.S. 10-year creeping down just a little bit. In all fairness, after such a big bounce here, it kind of makes sense to have a small pullback. We're kind of still in this mid-range here, not into resistance yet, but obviously pretty far away from support. Down sloping line, up sloping line there. Those are the levels I'm watching. You could even add in a secondary line here if you really wanted to. This could also be a little bit of support right down here, pivot low to pivot low. So again, we're talking, 4.27 to about 4.23 of support on the 10-year and resistance here. We did get a Fed official, but in all fairness, Fed Waller, he essentially yesterday came out and said, hey, I think we should cut rates in July, which is at the end of this month, really just about a week away from this meeting. But essentially what he was saying was he believes the labor market is weaker than even the numbers are construing. And he's encouraging a cut. But you might say, wow, this is a big change to the Fed. No, this has been one of the people on the Federal Reserve that has always been a dove and is always calling for a cut in rates. So it's really not a change in character for the Federal Reserve. And again, you would see a bigger move up in the markets if this was a new Fed official calling for a rate cut.
Gareth highlights that a weaker U.S. dollar has boosted multinational companies' earnings as foreign revenues convert into more dollars, but this currency tailwind may reverse if the dollar strengthens again. Netflix, despite its reported strength, showed weakness due to a bearish flag pattern on its chart, indicating potential downside if it breaks below $1,245. GE Aerospace reported strong earnings but still pulled back slightly, suggesting many stocks are simply overbought. American Express and 3 Million also delivered solid results. However, both show signs of nearing technical resistance zones, with 3 Million forming an inverse head and shoulders pattern that could target $186 in the coming weeks. Since June 23rd, XRP has increased by almost 92%. However, it has encountered significant resistance and is anticipated to drop, with substantial support located between $2.95 and $3. Overall, there are indications that both stocks and cryptocurrencies are technically stretched, and prudence is advised in the vicinity of significant resistance levels. Now, let's get back to the interview.
So the U.S. dollar has weakened, and that actually added profits to them. Now, the only reason I say that is because, okay, if the dollar continues to weaken, that's going to be good going forward. But if the dollar strengthens, there might be a hit next quarter. So something we just have to monitor here, that again, a large portion of how good their earnings were was due to currencies. All right. And again, this is where when they sell overseas and they convert it back to dollars, if the dollar has weakened, they get more dollars converting those foreign currencies back to U.S. dollars from, let's say, the euro, from the yen, from the Canadian, et cetera. All of these different currencies that they're getting. So again, that goes right to their bottom line. And you'll see that in a lot of the reports. Any company that has sales outside of the U.S. will get some tailwind from that. But again, that's not that their business is amazingly well. It's that they're getting currency rewards, essentially. So just a kind of a tidbit there that I thought was interesting. In terms of the daily chart on Netflix here, what do we have? We have Netflix again down here. I did point out going into Netflix, we had a small bearish pattern, so I'm not surprised that it's down. Although, again, it certainly isn't breaking the bear flag. And guys, for those of you that don't see the bear flag, I will draw it in. You have this move down and then this right here. See that? So down move, wide range red candle. Inside 1, 2, 3, 4, 5, 2, 4, 5 candles. And notice we never, like even yesterday was a strong update, but to negate the bear flag, it basically has to close above the red of the flagpole. And notice we did not do that. So the bear flag was still in play there, which again, it didn't give me a huge negative bias, but it just was a small negative bias going into earnings. And sure enough, the stock is down. It's not breaking the bear flag, though. I want to be clear on that. The bear flag would need to close below, basically below 1245 right here. And if it does, then you could see that next leg down to this downside target around 1180. GE, this is a good example, guys. So we just talked about how companies are reporting great numbers, but the stock has run too far too fast. This is a great example, GE Aerospace. In fact, on CNBC this morning, they were talking about what a shame that it got taken out of the Dow when it was almost like there was a risk of bankruptcy a few years ago, and the stock was down to like $6 a share. Now it's at $260 a share, and they were saying, oh man, it should be back in the Dow. Again, that's neither here nor there, but the point is on the chart is the stock gapped up on earnings, and I talked about this yesterday in the game plan. You have a trend line here. It gapped above that, and it just couldn't hold. So even on great earnings, the stock still had a small down day. Now, listen, this isn't a big sell-off. This is just a small downtick. But for me, it's validation of the trend line being firm and then how overbought so many of these stocks are, right? So again, just overbought to the nth degree. American Express. Here's American Express. They reported earnings this morning, $4.08 a share versus $3.86 a share expected. So very, very solid report. The stock is up a tiny bit, but this would be another one that it doesn't quite fit the GE or Netflix mold, but it's pretty close in that if we go to the daily chart, you can see the stock has rallied massively off of the lows. It did pull back a little into earnings, but nonetheless, you can see it's trading right here. It wouldn't shock me to see it stay here or even come back to the flat line. If it does go up, look at these two trend lines, guys. Great hidden trend line right here. Breakdown, retrace to the scene of the crime. This would be, again, double top, major trend line. So anything north of 330 to 335, that would be a huge swing trading short level on the AXP chart per the two trend lines right there. 3M reported earnings. The stock's up a little bit as well. If we look at the 3M chart, this isn't quite as extended, right? I mean, if you go back to January, it was basically trading here. So again, you even have an inverse head and shoulder pattern there. Do you guys see that on the chart? Love teaching these different patterns. Now, I'm not a huge lover of inverse head and shoulder patterns that occur near highs of charts, but nonetheless, it's there and it still has some credence. Shoulder, head, shoulder. It was already breaking. It already had broken above. So again, the stock is up. To figure out the targets of a head and shoulder pattern, as I always like to do, I love to teach you guys. So let's teach this. This is a pretty simple one. Bear with me here as I just bring up the right tool. But if we look at this, we take the low of the head to the neckline. All right, you take that distance, and then we have to actually bring this all the way down here, and we put it to the breakout point right there. So your upside target, if this plays out to target, would be 186. Now it's at 163 right now, pre-market. I don't, keep in mind, 186 is not today's target, right? I mean, 3M does not move like that. This would be if this pattern plays out fully in, let's say, the next month or 6 weeks or whatever it is, then this would go up here. This would actually be a level once this pattern is completed to pull the trigger on a short, right? That would be a trade that I could do on the short side potentially once this has been exhausted. Essentially, that target has been achieved. All right. Ethereum. Let's look at ETH here. ETH, again, great move up. I have a major target that I'm eyeing here. Take a look at this. You take your high from 2021, connect it to your high here in 2024. And if we get up to that line, that would be your target. Right now, that would be around just under 4,000. You could just round it to 4,000. That would be resistance. And then just above that, you have all these tops as well. So 4,000 to 4,100 is going to be a big. This has gone up 92%. Incredible rally, but it has slammed into resistance on a technical analysis basis. High pivot from 2021 connected to the high pivot from 2025 January. And what did we just pierce? Right there. So you would expect a pullback. I would say the pullback should be probably about the big support is going to come in right here around $3 to $2.95. So again, considering it's had such a run, that would just be your run-of-the-mill correction.
Silver is technically strong and might rise beyond its 2011 highs if momentum holds, despite short-term resistance around $39 in the market. Long-term bullish fundamentals are underscored by gold's resilience in the face of a risk-on attitude. Stocks are climbing on easing geopolitical tensions and growing tech confidence. Still, overbought conditions and unresolved macro concerns, including the dollar, rates, and Fed policy, call for cautious optimism, according to Gareth Soloway's market observations. Investors should keep a close eye on key resistance zones, as both stocks and cryptocurrencies appear to be stretched. Will silver continue to consolidate before making another move, or do you believe it can break over $39 soon? Over the next 3 months, are you more optimistic about stocks or precious metals? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful.